And good morning, and look who's back. Dunkin' Donuts and Kenny Polcari, your host of the party. And today is Monday, May 2nd, 2022. And I know I was away last week. I was in New York. I was on business. I didn't get a chance to record the videos or even write a daily letter on a regular basis last week because I just had a lot going on in the early morning. So it kind of got in the way. But I am back. I'm back in Florida. I'm back ready to go. And so here's what you need to know after what happened last week. And it was a brutal end of the week. And it was a brutal month of April, right? Because we all know that. And yes, and it was ugly, but it was the end of the month. And so therefore, you got to think about what that means. And we'll talk about that in a minute. The FOMC meets this week. The news will be out on Wednesday at 2 p.m. By now, you know that. ADP and the NFP report are also due out this week. So those will be key numbers for investors to watch. And Berkshire Hathaway had their annual meeting over the weekend. And from what we understand, it was both educational and entertaining. And what are we having for dinner tonight? We're going to try the spaghetti with asparagus. It's a great spring dish. So, like I said, oh my God, oh boy, was it a brutal day on Friday. And that ended a brutal month. So much for, Marky Zuckerberg saving the day with Facebook on Thursday, the way that Andrew Ross Sorkin told everybody. Stocks got slammed on Friday as the day drew to a close. And that's not surprising at all. It was, after all, the final day of the month. It was an opportunity for asset managers to clean house. And since April is not a quarter end month, no one's getting a report card per se like they do at the end of every quarter. So it makes sense that in an anxious environment when the Fed's about to announce the start of rate hiking cycle, an announcement that seems to change every week or every day, that the markets will remain on edge. I mean, you got to think about it just for 1 minute. Think about where we were in January, what the tone of the conversation was then, and how it has changed dramatically. Toss in the Putin war, exploding inflation across every spectrum, the Fed that appears to have lost complete control of the narrative, and the most recent GDP print that reveals negative growth, which was a big surprise, by the way, to all the analysts who had predicted otherwise. And now you ask, why are stocks continuing to be under pressure? Remember, in the fall of 2021, when hints of policy change began to simmer on the back burner, when inflation readings were steadily increasing month over month, remember what I told you then. I said, look, the macro data is changing. Inflation is rearing its ugly head. The Fed is hinting at policy change. At the time, it was a minor change. Now it's much more of a major change. So you'd have to expect that valuations have to change. Because when you change the inputs, the output or the answer also has to change as well, right? It's not that difficult. It's a math problem. So think of valuations like this, right? Because like I said, it is nothing more than a math problem. The expectation, for instance, was for the equation to be 10 plus 10, which equals 20. And so investors were willing to pay X times for that valuation. But when the equation suddenly becomes 5 plus 5, that only equals 10, or 50% of the original expectation. So investors will need to decide what that new valuation is worth. And it's not worth X times any longer. So as the economy slows due to declining economic activity, or rising rates, or surging inflation, or the combination of all three, then valuations have to change. That's just what we're seeing now, right? As a result, stock prices are in retreat. And at the end of the day on Friday, stocks retreated. The Dow gave up 940 points or 2.8%. The S&P off 155 or 3.6%. The Nasdaq down 540 points or 4%. The Russell gave back 55 points or 2.8%. And the transports coughed up 460 points or 3%. And that now puts all of these indexes well into negative territory for the year, which doesn't reflect the pain seen from the highs of 2021, right? Because they're down even more from there. Year to date, the Dow is down 9.2%, the S&P down 13%, the Nasdaq down 21%, the Russell's lower by 17%, and the transports are up by nearly 10%. And to be clearer, the Nasdaq and Russell are both down more than 24%, from their November highs, putting them solidly in a bear market. So it has not been pretty at all, but you can't say you're completely surprised, because if you are, then you've been living in a cave all of this time. Recall that the conversation about how the Fed was going to be slow and methodical when it came to policy change, not swift or haphazard, and how that conversation has since changed. Recall how some of the Fed members tried to jawbone the markets a bit lower just to take some of the fluff out without causing angst. How the committee was split on what should happen and when it should happen, etc. And then recall how that changed, and how that changed dramatically. Suddenly all the members of the Fed on the same side of the fence. Even Dove Lael Brainerd switched her feathers to become a hawk. And she pointed out that the Fed needed to be more aggressive, something that most of the country already knew, but were being told, no, don't worry, it's okay, we got it. 10-year Treasury prices have retreated, and that means yields have surged, and that surge is equal to 98%. Recall that yields were 1.5% in January. They ended the day on Friday yielding 2.93% and only going higher. Mortgage rates have also surged. 30-year money was 2.75% in January. It is now more than 5% for the same money. That's an 81% increase in the cost of that mortgage over the 4 or 5 months. Oil has gone from $73 a barrel in January to a high of $120, settling in at $102 a barrel on Friday, representing a 40% increase in the cost of energy, while gasoline at the pump has increased by the like amount as well. Earnings for the second quarter have been mixed. Beats on the bottom line, misses on the top line, mixed forward guidance for the next 4 to 6 months has only added to the angst that investors are feeling. Disappointment at Apple and Amazon are only the latest reasons for the sell-off. But I have to really ask, were these results really disappointing? I mean, think about this for 1 minute. Apple reported revenues of $97.2 billion for the quarter. That's a 3-month period. While Amazon reported first quarter sales of $116.4 billion, that somehow turned into a $38 billion loss. Let's not even go there. And let's not kid ourselves. They said they had sales of $116.4 billion in 3 months. So you got to get over yourself. The reaction in the market was ridiculous. It's both Apple and Amazon, two companies that are changing the world. To be clear, we're not talking about Robinhood, which is down 98%, or Teladoc down 81% from their all-time highs. Apple's down 13% year-to-date, and Amazon is down 28% year-to-date, while the broader market's down 13%, all because the Fed has signaled confusion and sent the message that they have lost control of the narrative. Essentially, the Fed is losing credibility, and the idea that we're depending on the Fed to solve a problem that they created only creates more angst. So get ready. But in my opinion, Apple and Amazon, you just don't throw those names out. You just don't. So in my view, this is a huge opportunity. Now, over the weekend, we had the Berkshire Hathaway annual meeting. It was entertaining, if nothing else. They took shots at Bitcoin and Robinhood and offered up all kinds of advice to investors. I think the Robinhood commentary was hysterical. You'll see it played over and over today and this week. This morning, it's a new month, and guess what? U.S. futures are up. Oh, boy, surprise. Guess what? Dow futures are up 180 points. The S&P's up 25. The Nasdaq's up 85. The Russell's up 10. There is not anything new between Friday's sell-off and this morning. The macro data is the same. The Fed is in lockdown mode. The only difference is that stock prices are beginning the month at lower prices than they began last month. And if we get a 50 basis point move on rates on Wednesday and a sense that we'll get another 50 in a move in rates in June, then I think the market stabilizes, because that's what we're expecting. But if the conversation is more aggressive than that, think 75 basis points in June and possibly July, then I think the markets will continue to struggle a bit until it comes to new terms. In any event, you got to prepare yourself for continued volatility in the weeks ahead, making sure to adjust or to add your portfolio with names that make sense. Value continues to be the play for me, right? But that's me. Communications, the XLC, is down 24% year to date. Consumer discretionary, XLA, down 21%. Tech, XLK, down 19%. Semiconductors, the SOXX ETF, down 26%. Retail, XRT, down 22%. Yet on the flip side, you got metals and miners, the XME, up 26%. You got fertilizer names and coal names are up big. Energy's up 35%. Consumer staples and utilities are flat on the year, which is a win. And they're also good, big dividend payers. Going short has also yielded big benefits with the SH, PSQ, and DOG ETFs all up on the year, 12, 22, and 8% respectively. Eco data today includes the S&P manufacturing PMI of 59.7, while ISM manufacturing PMI is expected at 57.6, both expansionary. Tomorrow brings us factory orders, durable goods, and capital goods ordered and shipped. Wednesday is the all-important day, the FOMC rate decision, and as discussed, we're expecting a 50 basis point increase, which then puts us in the 0.75% to 1% range. Wednesday also brings us the ADP report, right? Expected 400,000 new jobs. And Friday brings us the non-farm payroll report. And here we're also expecting an increase of 385,000 new jobs. Average hourly earnings month over month expected to be up 0.4%, while year over year they're expected to be up 5.5%. Unemployment is expected to go to 3.5%, while the underemployment rate is at 6.7%. Look, at the end of the day, markets were in an oversold position, which does not mean that they can't go lower. It just means that it can and remain irrational until we get more clarity. Remember, the market can deal with both good news and bad news, but it has difficulty with uncertain news. Earnings will continue as we wind down into the end of reporting season. So, we're going to get a few earnings here and there throughout the week. The S&P closed the day at 41.31 after testing as low as 41.24. Still not piercing the February low of 41.14. And while this morning feels like a bit of a relief, do not let your guard down just yet. What the Fed says on Wednesday will determine the next move. Recall that the Fed's in a quiet period now, so do not expect to hear anything from the FOMC members until Wednesday. Many analysts are speculating on the narrative, trying to change the story, going from multiple 75 basis point moves in June and July to 50 next week, then 50 in June, and then maybe 25 at each of the remaining meetings, bringing us to 2.5% by year end, down from last week's hysterical 3.5% that has been bandied about, right? Now remember, these are not Fed officials saying this, but it could be the Fed that is leaking the story to analysts to prep the markets, right? They always do. They leak the info. They allow the big boys to say it, put it out there in the public square. And then when they say it, everyone looks like a hero. It will also serve to hopefully stop some of the selling if markets think that the Fed moves will not be as aggressive as the narrative. In the end, stick to the plan. Invest in good, solid names. Do your homework. Remember that in all this chaos, sometimes it creates opportunities for the long-term investor. All right, so that's my story for today, and I'm sticking with it. So what are we having for dinner? We're having spaghetti and asparagus, right? It is a great springtime dish, right? It looks great on the plate. It's pleasing to the eye and to the palate. Right? You want to try this on a night when you can set the table outside, play some classic, maybe Gigi D'Alessio on Spotify, and then enjoy the evening. Bring out some candles, set the table, do it all right. Now for this you need a half a pound of fresh asparagus spears. You need diced pancetta, sliced garlic, a half a cup of white wine, grated pecorino romano cheese. You need finely chopped fresh parsley and a pound of spaghetti. Right? You can use, and you can use, if you need gluten-free spaghetti, go for it. Begin by trimming the asparagus, right, and cut it into 2-inch pieces. So take the white part of the stalk off and then cut the rest into 2-inch pieces, right? You want to get rid of the white parts, right? Now blanch the asparagus in boiling water until tender and crisp, and then drop them in a bowl of ice water to stop the cooking process, right? Because you don't want to overcook them. You want the asparagus to be firm to the bite, not limp. Once cooked, you want to just save the flowers, right? Take the stalks one point and save the flowers on the side. In a large saute pan, saute the pancetta and garlic in some olive oil. Don't burn it. Add the asparagus, stir it around. Add the white wine and cook until it's been completely absorbed. Now, You've got your big pot of water, salted water in the back burner. You brought it up to a rolling boil. Now you're going to add the spaghetti. Cook it for 8 to 10 minutes until it's al dente. You know the drill, right? You want to drain it, always saving some water. Then add the pasta to the saute pan with the pancetta and asparagus. You want to take a little bit of the water and add it back just to keep it moist. You don't want it to puddle, just a little bit to keep it moist. You want to stir it because it'll be nice and hot. Mix it well. You want to toss it a handful of grated Romano cheese. You want to serve it in warm mixing bowls, and then you want to adorn it with the flour of the broccoli. So you want to put some of those flowers right on top. Always have extra cheese on the table for your guests, and you're going to serve this with a nice chilled white wine, right? Something like, my favorite, Pinot Grigio Santa Margherita would be my call. I'd also use that to cook with. If you don't want to use white wine in the dish, you can substitute chicken stock for the white wine. You can always do that with never a problem. In any event, the day is just getting started. It's going to be beautiful here in South Florida. I hope you have a good day. Until tomorrow, take good care.